Hello, everybody. Welcome to Friday. Looking forward to our session as always. The market is off and running. We're getting started. Uh, Apologize for some technical issues that we had last week. Hopefully, those have been worked out and we'll have a smoother operation today. Looking forward, as always, to our discussion. So, uh, grateful for those that are here. Hopefully, we'll have a few more coming in as we get things rolling. Just to kind of lay a little bit of a foundation for the discussion for those who, whether you're live or possibly looking at this live stream after the fact, who may not be familiar with kind of the format that we use here for this live stream. The idea behind this is to talk about what's going on in the market as it relates to the investments that we're following with the Rebel income system. So I publish a trade each Tuesday for members of the Rebel income community based on income generation using the options market as opposed to buying or selling stocks outright. My preference is to look for high value value based opportunities in the market. Sorry, it is a little bit early. To look for high value based opportunities in the market with strong fundamentals and deep discounts, and then use options, put selling specifically as an opportunity or as the gateway to possibly owning that stock. The put sale allows me to generate immediate income on those stocks, and then if the put sale ends up with me being assigned the shares at or before expiration, then I tend to accept that assignment and look for opportunities then to work with the stock a little bit more using covered calls. These are also stocks. One of the primary criteria of the Rebel income system is dividends. So I only work with dividend paying stocks. That means that when I take an assignment, I have an opportunity to bring in those dividends if I hold the stock through a dividend declaration. Excuse me. So that's kind of the basis for how we approach our trades. Good morning, Gib. Good morning, Jay. Welcome. Excited to have you here, and looking forward to our discussion. So there's always a lot to talk about because the market is the market, and things are always adjusting and moving. And of course, that means that there's a lot of things that are happening, and excuse me. In most weeks, we usually have trades to look at that are set for expiration on Friday. That's one of the reasons I like doing this live stream on Friday, live while the market is open, is because it is expiration Friday every week for a pretty broad set of options, for a pretty broad set of stocks. Excuse me, and their respective options chains. This week, we actually don't have any. That's a little bit of a rarity, but that's all right. I do have a number of trades coming up in the weeks ahead, so we'll be able to dive in and take a look at those, and probably have some opportunity and time to look at some of the stocks that some of you are following as well. And of course, there's always opportunities to answer questions that you may have. would certainly appreciate your insights, whether it's about the stocks that we're talking about. Barry, your Delta Airlines expires today. Okay. And I already took assignment on those. So here is Delta. I was assigned last week. The stock was about $4 below the strike price that I was assigned. It's recovered a little bit since then. We'll just go ahead and use that as the segue to get things rolling. So thank you, Barry. Here is Delta. It's recovered a bit off of a low here around 51, I'd say, and we see it rallying a little bit, even though it's a little bit lower today. So Barry's strike yours. He went a little bit lower. He's at 54. But if this early market action holds, looks like you may be assigned. Who knows? A lot can happen yet. We are literally just 5 minutes into the trading session, right? So we'll see how this shakes out eventually. But that's kind of where things stand right now. I was assigned at 55, so I'm in right here, and so I'm waiting for the stock to rally a little bit more, and we've got pretty strong resistance right now from both the 20 and the 200-day moving averages, which are right around my assignment price at 55. So in literal terms, I'm looking for a break above 55 as an opportunity to start looking for covered call trades on this stock. But we'll see. There may be some things that come up if it can get above 54 and somewhere between 54 and 55, there may be some opportunities to work with covered calls on that. But this is, airlines are a little bit sensitive, obviously. Well, more than a little bit sensitive to the economy, and so they have some sensitivity to things like tariffs, etc. Interest rates, certainly. But Delta is in a very, very strong fundamental place in terms of their balance sheet, in terms of the way that they've been running their business lately. So cyclicality aside, business travel has been rebounding nicely, and that's provided a nice lift. I like the trend that this has been following. Obviously, it's kind of hard to ignore this increase from 34 up to the stock's current price around 50. This is now an intermediate upward trend, which is nice. That's suggesting that the stock is increasing its technical strength. Gib, why not just enter the 55 call? That's what you paid, right? Well, that's a fair question. Let's go ahead and take a look at it. I might, and I'm certainly not afraid of selling the strike price that I bought at. Right, it just generates additional income, and even if I get called out at that price, I have the premiums from my put sale from the covered call, and those are usually enough. So let's see. Again, a lot of it depends on what the stock is doing and where that sits right now. So let's take a look. Let's go out 2 weeks, first of all. And here's the 55 for 2 weeks out. Can bring in 87 cents. That's not terrible. About 20 cents difference between the bid and ask prices here. Oops. Sorry, I picked the wrong contract. It's on the wrong side of the option chain. My bad. There we go. 86, $1. That's not the worst. Maybe I don't have to wait for it to get a lot higher, right? That is interesting. Even if I go out 3 weeks, there's 86 for 56. Yeah, and Barry maybe even put in a day order for the midpoint. Now, I'm not going to put in any orders here live, but I am going to watch this and see. And part of the reason I don't do this live is because any trades that I place, any trades I place in the Rebel Income account, I publish first. I let you know about them before I place them. And in order to avoid the perception or even the potential of front running these trades, I wait a day after I've published them. So these are all really actually interesting options. To be honest with you, Gib, if I'm being completely transparent, I hadn't really looked this morning at where things were sitting for Delta, but this is interesting. And so here's 86 cents for 56. $1.17 for 55 for 3 weeks. That's really not bad at all. $1.09 to go out a month. Again, there's still about a 20-cent difference, a little over that between the bid and the ask. Means there may not be a ton of volume here. Yeah. But plenty of open interest to work with. That's enough to be functional, right? So, and I'm starting the session at the bell. That's exactly right, Barry. So we'll see. Again, there's a lot here that still has to play out, shake out, etc. But this is actually looking pretty nice. I will really be looking more towards Tuesday, to be totally honest, for another cover call. Again, just because I don't place these trades on the fly. I publish them for you first. I announce them, and then I place them the next day. So that tends to moderate how often I trade a little bit. That's where Delta is for me right now. That's showing some interesting momentum, to be sure. All right. Thank you, Barry. In the meantime, you're assuming you're assigned at 54. That's actually not really a bad place to be right now, given what the stock's momentum is doing. Looks like you would probably have another opportunity Monday, assuming all things are equal. Probably a good opportunity to set up a covered call trade on Monday. So, not a recommendation to buy or sell, but in any case. All right. Anybody else has anything else to share on Delta? Please go ahead and do it. If you have another idea, another variation, I'm always interested to see those. All right, let's talk about put sales. Rather than just going out to the next week, I'm going to go in chronological order of trade placed, because the expirations have gotten a little bit flipped. The first put sale that I have on deck that's still pending is a put sale on Campbell Soup that I placed last week. Brought in about 2%. Yeah. Place this on Campbell Soup. It expires on the 22nd. So this is still about 2 weeks out from expiration. And I sold the $32 strike price. Keep in mind, I brought in the 65 cents. That'll be important for comparison as we're looking at what else may be going on with the stock and seeing what might be the potential things that we can do to try to manage the trade. So stock is showing some good momentum. It's tracing right along. Oops. Wrong keys. I can type. There we go. It is tracing nicely right along its 20-day moving average. It's using this as pretty good support, which is kind of nice to see. We do have pivot high resistance right here. I'm going to call this probably about 33.50. And sorry, that's a bad line, but we'll call this 33.50 roughly. So in order for it to maintain this very short-term upward trend that it has so far off of this is a multi-year low for Campbell Soup down here at around 30. In order to break above 33.50, in order to maintain this upward trend, I should say, we're going to need to see a break above 33.50. Now, I sold on this one. Again, I sold the 32 contract. So as far as the trade is concerned, this looks pretty good so far. Now, again, there's still 2 weeks to expiration. That means a lot can happen, obviously, in those 2 days. But the trend is looking nice, the short-term trend at least. We'll see what it can do around this pivot high. So, yeah, right around 33.50. It'll be interesting to see that. So let's take a look at what's happening with the options on CPB right now. All right, and I sold the 22nd. There we go. And keep in mind, I brought in 65 cents. And here's my strike price. And so if I wanted to buy this back right now, I'd have to do it at 50 cents. Not really a motivating reason to do that, right? And I am only a week into this trade. The stocks, Campbell Soup is one of these stocks that, the short-term trend aside, this isn't a stock that moves really fast. That's actually one of the things I like about it, to be totally honest. Some of these less volatile stocks, it doesn't mean that their trends aren't useful over time. It means they're a little bit less remarkable, which is why they don't get talked about a lot, in market media. You don't hear about these because they don't. You don't see big multi-dollar moves in 1 or 2 days with these stocks as a general rule. Excuse me. But that's also really actually works out really well for option selling, and especially when you have a company like Campbell's with a really good fundamental profile, very interesting value proposition. From an income generation standpoint, that means that you can usually do quite a lot with this kind of stock. Even if the stock does end up falling below 32, which right now it's looking pretty good, I'm okay with that because that is very, very near that multi-year low, like I mentioned, at 30. But right now it looks like it's in a pretty good spot. For now, I'd say that the best action with this one is no action, and just letting the market continue to play out, and let the effect of time play its role. One of the reasons, really, we don't talk about this a ton in this live stream, but one of the main reasons for selling very short-term options, really, because I focus on contracts that expire in a month or less. I really don't like going out more than 4 weeks if I don't have to. It's very rare that I do. And part of the reason for that is the effect of time decay. There's a significant difference, even from 1 week to the next, in terms of the way that time impacts the value of an option. Option values are calculated based on a lot of things, and the stock's current price is certainly one of those. The day-to-day action swings from high to low. The volatility of the stock factors into the implied volatility of the options, and so that contributes to some of the volatility in option prices. But one of the biggest impacts on options is time. And I've gone to the 7-day contract here to try to illustrate this. Here is the 32 contract for next week. And look at the bid-ask spread here. We're looking at 20 cents on the bid, 30 cents on the ask. Okay, that's interesting. Now, that's not necessarily indicative of anything. That's just the reference point, because that is the next, aside from today, that's the next available contract. Here's today for 32. We don't have a different ask here. The bid is nothing. The main reason for this difference is because of the fact that there's likely been no activity, right? There's no volume here so far today on this contract. Plenty of open interest here, but look at the previous close. This is yesterday's close, was 7 cents. So let's use that as the reference. Let's call that the value of this contract right now is a little bit less than 7.5 cents. This is where it closed. We're 20 minutes into the open, so this is probably a little bit closer to 7 cents now. And since this is the day of expiration, time is literally, the value of this option is literally decaying a little bit more with every single passing minute. So if 7 cents is the reference here for the 32 contract that expires today, then we go back to our 7 days and we see 20 to 30 for the same strike price, 35 to 50 for 14 days, we start to see 40 to 75. The spread is getting wider here as we go further out in time. By the way, this is not typical, but again, look at the way that the prices are changing as we go out further in time. Now let's go out as far as we have here. Here's 49 days, 32. Again, so what we're seeing here is a very, very real reflection of the way that time impacts these options. The closer we get to expiration, the more time decay affects the price of an option in a negative way. And that's true no matter what the actual direction of the stock is. Time decay is a constant, and it's not even limited to days that the market is open. Time decay happens on the weekends. It happens on holidays, when the banks are closed, when the market is closed. Happens on Christmas. Time decay is a constant, and that's a reality that puts option buyers, to be completely frank, at a big disadvantage. If you've ever bought an option, tell me if you haven't had this experience, but I'm willing to bet that you have. Have you bought a call option on a stock because you thought it was going to go up? And you were actually right. It did end up going up, but it didn't go up in the time that you had bought. It didn't go up in time with enough time left in the call contract that you bought for you to really be able to get anything out of it. Have you ever had it happen so late that by the time it happened, it basically just made up for some of the losses that you had been seeing in the call in the intervening period? I've had that happen where I bought the call option, the stock went down, I held the call option for a little bit longer, holding out hope, and the stock did end up rallying a little bit before the option expired. But the negative impact while the stock was going down was so extreme that by the time the stock started to rally, it didn't matter. It barely made up the difference. Gib, I don't want the option buyers to know this. The thing is about that, Gib, even if there are option buyers that end up watching this, there's always more. So this is a literal reality of buying and selling, or excuse me, of buying call and put options. That means this is part of the reason that the probability numbers, excuse me, probabilities of success for traditional trading strategies, buying calls, buying puts, buying stocks outright, shorting stocks. It's the reason that the probabilities for those kinds of strategies are so small. You're really lucky if you can make money, 25 to 30% of the time, and the rest of the time you're having to manage downside for 70 to 75% of your trades or more. For me, it was often more like a 20 to 25% probability of success. So I was losing as much as 80% of the time. It is possible to be profitable in those conditions. I'm not ever going to say that it isn't, but it's really difficult. It's really difficult because it requires a lot of discipline and the ability to understand how money management really, really works. And to be totally honest, there are very few of us, myself included. I'm putting myself in the group that doesn't really do great at this. Most of us lack the either the emotional fortitude, for lack of a better word, to really enforce that kind of discipline, trade in, trade out every single time over time. When you're watching a string of however many losses in a row, it's really hard to hang on to that discipline. That's not just an an emotional reality. It's also, in many cases, for a lot of people, a financial reality. Um, let's face it, a lot of average investors are putting hard-earned money that they've worked very, very hard to save into the markets, and then they're using these strategies, and then they're wondering why they're failing, why it doesn't work. And there's a book that I read a long time ago called The High Probability Trader by a very smart man named Marcel Link. This is a book I highly recommend because this is one of the things that started to shift my understanding and the way that I thought about successful trading. He talks a lot about the tuition that traders have to pay. It's just like going to college in order to figure out who they are as traders. Well, in my opinion, you can pay tuition a couple of different ways. You can do it financially, certainly. I did that. That was painful. Um, you can try to follow other people like me or other people who talk about trading as well, and try to use some of that information. And that's all. And that can be a great thing. Obviously, that's one of the reasons I'm doing what I'm doing now. But ultimately, what you ultimately have to do is experiment. For me, if I'm trying to talk about how to accelerate that learning curve and figure out who you are as an investor, try to do it better than I did. It took me years to come around to what I'm doing now with Rebel Income and settle into this is who I am as a trader. The best way that I can suggest doing that is to experiment earlier with different strategies. Try to study up on lots of different methods and approaches, and experiment with the ones that make the most sense to you. I'm not trying to soapbox here, but this is one of the things that led me to Rebel Income, and to put selling and income generation is trying to understand how to put probabilities of success in my favor. Excuse me. Wow, probabilities of success in my failure? That doesn't make sense. When I began to really understand the real probabilities of success in traditional trading strategies, I started to think about, well, if it's so bad on the one side, what about for the opposite side? There's got to be there's got to be some give and take here that establishes balance in the market, and there is. It's those of us that are the option sellers. The probabilities of success are much higher. And in many cases, if the probabilities of success are 20 to 25% or maybe 30% for a buyer, that means logically that the probability of success should be 70, 75, 80% for an option seller. And in a lot of cases, that's very, very true. That logic actually holds. Whether your approach is to take a little bit more time and be a little bit more passive like I do, or whether you prefer to be a little bit more active about managing the trades that you're placing. I tend to place a trade, I wait till the expiration, and the result is the result. If I get assigned, I get assigned. If I get called out of a stock that I've been holding and I've sold a covered call, then I get called out. That's fine. There are a lot of other people that like to sell options as well, that take a more active approach. They're going to not necessarily just wait for expiration, but they're going to look for opportunities to manage these trades in between. And that's also an advantage. Not only the probabilities shift a little bit, I've been able to shift mine from that 20 to 25% that I mentioned up into the high 90s, doing it the way that I do it. More active traders, the probabilities are a little bit lower, about 80 to 85%, but they also have a higher number of trades. They'll buy options back sometimes a week, 2 weeks before expiration if they've got a good move that allows them, for example, to capture 50% or more of the premium that they brought in. You're buying a put option back. If I sold a contract on Campbell's, for example, at 65 cents, and now there's an opportunity to buy it back from the market for 25 cents, I'm still a couple of weeks from expiration, uh, and I'm able to close out the obligation. That's an advantage because I'm able to capture most of that premium. I'm able to keep 40 cents of that premium. I'm still 2 weeks away from that expiration. I've closed out that obligation. I get my capital back immediately as soon as that trade closes, and now I could redeploy it. Whereas before I was planning on letting it wait for a couple of weeks longer. Now I can place another trade. I'm increasing the trading frequency. And when you increase the trading frequency with a high probability of success, what you create is a higher compounding effect. And that's really cool. That's one of the reasons why you'll see me talk about what some of the other possibilities are going to be, whether to buy an option back or whether to hold on to it a little bit longer. That's one of the things I was looking at here with this $32 strike price right now. Here's the contract that I sold. Again, I brought in 65 cents. To buy it back would cost me 50 cents. It doesn't really make sense to try to close that out right now because I'd only keep 10 cents and that's not enough. Even if I were a more active trader, which I'm not, this is something that I wouldn't do. Gib makes the most seen is the key. I've studied a bunch, but this site, they finally delivered a theory that I understood. I appreciate that, Gib. Really, yeah. What makes the most sense? I think is what I think the way that I read it is not what you meant. I think what you meant is what makes the most sense, and that's exactly right. What resonates the most? There is not a single best strategy in the market. This is one of the things that I've learned. I've got a lot of friends who like to trade the markets, and I like to compare notes with them and see what they do that is successful, what they like, what they don't. I tell them about what I do. We kind of compare notes. Sometimes I end up using some of the things that they do. I find ways to fold that into some of my methods. Sometimes I don't. Sometimes I'm okay with what they're doing, and that's fine. If it's successful for them, they like it. It allows them to have their money working for them in an effective way while they go about the rest of their life. That's awesome. This is what makes the most sense for me. I'm right in the same boat with Gib. This is what makes the most sense. So thank you. I appreciate that comment. Okay, let's go ahead and get back and let's start talking about some of these other stocks here. This was Campbell Soup. Again, 2 weeks to expiration on this one. This week's put sale on CVS expires next week, and then there's a couple of covered calls that we'll take a look at here as well. But let's go ahead and start with this put sale. I sold the $63 strike price on this one. Made a little bit of an adjustment from the trade that I published. If you saw the trading alert on Tuesday, again, this was all about market action, and actually, I was able to do a little bit better by shortening my time frame a little bit and by going to the 63. It was kind of interesting. The stock had gone up a little bit from Tuesday to Wednesday, and that's why there we go. Computer's a little slow to catch up. So I sold the 63. We can see CVS is showing a little bit of bullish momentum here, rallying off of this low at around 58. Lost my screen. Okay. Thank you, Jay. Give me just a moment. Okay, can everybody see my screen again? I apologize for the interruption. Okay, thank you very much. All right, so we have a little bit of positive momentum going on for CVS right now, rallying off of this low. What is this? Probably around 58.50 roughly in late July, and showing some good momentum here up around 64, starting to approach 64.50 right now. So see some positive momentum. It's above both of its moving averages, and really. Looks like we've probably got, well, we've got some resistance coming up, don't we? We're following all of this pivot activity in February and April. Oops, and that's a really ugly line. We're really starting to come right up against it, maybe even pushing above it a little bit. That's interesting. This is increasing momentum, which means that the next point of resistance is probably, if it can keep this momentum up, it's probably going to drive up to around 68. Well, maybe 66.50, between 66.50 to 68, very possibly, based on, here we go. That's a little bit above 66 roughly, not a ton. So we'll see. But that is showing some nice momentum. So now the question is, relative to the contract that I sold, this is really just a few days in, but it's only 9 days to expiration. So when we talk about time decay here, is it possible that that's enough to maybe consider doing something different with this contract? Sometimes that happens only within a few days. It's kind of rare in my experience, but it does happen. So let's take a look. Okay. Here is, wow. Here's my contract, 63. There's the asking price. Remember, I got $1.15 when I sold this. So I'm already 65 cents positive on this. That's a little over 50%. There's no volume here so far on this, but there's enough open interest. Again, I'm not saying buy or sell here. It's not a recommendation, and I'm going to continue to hold this and let this play out because that's the method that I prefer. But it's possible here. Bid ask has even shortened up a little bit more here. I could probably, if you wanted to not, if I wanted to just simply take this 54 cents, I could hang on to about 61 cents of that premium, close out the obligation of a full week before expiration. Would have only had the trade for 2 days. That means my total yield would be a little bit less than 1%. That's less than 1% for 2 days. Because I placed this trade on Wednesday. That's actually kind of sick. Sick in a good way. Let's put this in context. I mean, these numbers are not going to be exactly realistic because you're not going to be able to do this over and over and over again. You're not going to be able to repeat this kind of thing the same way every single time. Here's 0.6 divided by 63. So 9.5%, or excuse me, not 9.5%, excuse me, 0.95%. Just a little under 1%. Now, You think about this, over the course of a year, if you annualize the number of days that you're in the trade, 2 days, possibly up to 130 trades. .95, 123%. Yeah, Gib, I would have a buy to close order in on this one. This is why. You're exactly right, Gib. And this is why this is why a lot of people in the Rebel Income community, a lot of our friends who have been on past live streams, if they could, they would be knocking me over the head saying, "Why haven't you already done this? Why aren't you doing this right now?" This is actually really cool. And there is a next question when you are managing trades actively like this. Okay, you close out the obligation. You've made that nice return for 2 days. What do you do next with the money? How do you turn that around to the next trade? Well, you're still 7 days out. The stock is starting to increase in momentum above 64. What about the $64 strike? There's 80 cents on the bid, a little over 1% for 7 more days. If the stock's momentum still continues, a good chance you'll have another opportunity sometime next week to close it out before expiration. And if not, you brought in 80 cents on top of the 60 cents that I'd be able to take in right now by buying the option back. Now you're talking about $1.40. Let's talk about compounding right now. Here's $1.40, excuse me, $1.40. Let's split the difference between 63 and 64. Call 63.50. And you've generated a 2.2% for a 2-week period of time. Or excuse me, for 9 days. Not quite 2 weeks. Jay says, in my opinion, is that we'll drop below 64 next week. Could. We're right here at resistance. It was certainly challenging it earlier, just a few minutes ago. It's come back a little bit. We'll see if it does that. It could it could just as easily though cycle back up towards the top of this range that it's been following really since February. I'd say it's kind of a 50-50 likelihood that that's what happens. But we're seeing some strength here, and that's providing an opportunity here to think about how to adjust your trade and increase your success. This is when I talk about placing more trades, increasing your trading frequency to increase the compounding effect. I have one trade for CVS, and assuming it expires worthless, I will have made 1.83%. The opportunity right now to buy the option back, then turn around and sell. Again, this is not a recommendation. This is just an example. But the opportunity to buy the 63 back, sell the 64, same expiration, increases the yield from 1.83% to 2.2%. Maybe a little under 0.5% doesn't sound like it makes a really big difference, but you're working with the same period of time. You did this in 2 days if you decide to do it. That's the advantage. This is why I do this. This is not only why I talk about puts. This is why these are the trades that I place. because that's what these opportunities are. When I talk about the low-hanging fruit of the market, this is it. This is the money that's just sitting there waiting to be claimed that most people don't even see, because they're too wrapped up in trying to figure out how far is the stock going to go, how much can I maximize my, how much can I maximize my profit so that the next party I go to, I can tell everybody how much money I made on XYZ. This is why they keep chasing buzz, and they ignore stuff like this. Again, the kinds of opportunities that see the system, you get more often things like CPB, where you look at it and it's okay, wait for another week and see what happens. That's the norm. By being a put seller, by actively looking at these, and even though my method of and frequency of placing trades is not as active as others, it doesn't mean that I'm not paying attention each week. I am each day, excuse me, because I am. I'm looking at these every single day. I'm evaluating where things are at compared to the purchase prices of the stocks that I own, compared to the trades that I have open, and I'm trying to evaluate what those opportunities and possibilities may be. But by approaching this from the standpoint of being a seller first, this is how I find these opportunities. I wouldn't be finding these opportunities at all if I weren't doing it, if I weren't placing these kinds of trades every single week. So this is I know that for most of you I'm preaching to the choir. But this is why we have such an advantage in what we're doing with put selling. So, and thank you for the like. I appreciate that. Okay, let's take a look at a couple of the covered calls. And these are stocks that I've taken assignments for in the past. And I've been holding on to them for a little while. First one is BorgWarner. And just to give you a little bit of perspective on BorgWarner, I've been holding this one for a little while, since December of last year. I was assigned at 32.50. And yes, this is a stock that lost the subscreens. Okay. Thank you. Give me just a moment. All right, let me know if you have it back. Okay, thank you, Barry. Appreciate that. So I was assigned BorgWarner at 32.50 in December. Thank you, Gib. And have been able to place a number of trades on it since then. Here's a covered call at 32.50 in February. And most recent covered call was right here towards the end of July. And the stock had picked up some momentum. Now, why the big difference? Why didn't I sell a covered call earlier? This is one that really only just started to really pick up a lot of momentum. And BorgWarner is one of these stocks that doesn't offer weekly options. And so because it's monthly options only, I should say, that doesn't mean that it's harder, that there are less trades to place, but it does mean that the dynamics are different enough that sometimes you have to wait for a bigger move. And it really had to, it took a little bit of time here to get to a point where it was offering something a little bit more useful. So, but we can see the stock showing a lot of momentum here, pushing above $38 right now. That means for me, obviously, the expectation is that I will likely be called out at 37.50. This is for next week. and that means that I'll claim about a $5 profit on the trade on top of the premiums that I brought in. On top of the premiums and also the dividends. Remember, I've held it since December. That means that I got this dividend at 11 cents and this one as well. The dividend may not look huge, but it's functional. It's enough, and that's been pretty effective. And so we've seen, obviously, we got some nice movement here following their earnings report that has really driven it a lot higher. This was already looking pretty good for me at around 35, but it's really picked up a lot of momentum since then. So we'll see how this one finishes, but it looks like all things being equal, this is going to be a happy result, because when you can put a little capital gain on top of the income that you generate from these trades and from the dividends, let's not lie, that's nice. It certainly helps to see that. Okay, the other was a covered call on Barrick Mining. That was this week. And to be clear on this one, I've held this one for a lot longer. I'm in on this one at $20.50. And Barrick is one of these. It's a mining company, specifically focuses on gold primarily, formerly known as Barrick Gold. And I've used this stock quite a bit over the last few years as kind of a little bit of a hedge against some of the, it's not necessarily inflation, but market volatility. When inflation and geopolitical risks, broad economic risks are increasing, then there tends to be kind of a flight to safety that includes precious metals. And so I like to use mining companies like Barrick as kind of a proxy for the precious metal itself. In this case, this is a 9-day trade where I sold the $23 strike for about 48 cents, brought in a little over 2% on that trade. Now I've held this for a few years, so this is a little bit of a larger position than normal for me right now, with 300 shares held. That's why I sold three contracts on this. Means that if I am called out, I've got about $2.50 of capital gain built in on this one. I have about $5 on Borg Warner. So both of these trades are looking like they could give me not only nice premiums, nice income from the covered call trade itself, but also possibly some capital gains. And this one, I need to reset the chart here. There we go. Barrick picked up so much momentum it threw my chart off kilter. That's funny. Starting to go parabolic, in fact. It was consolidating right here around 2050, and there were a couple of opportunities to do some covered calls in this during this period here that were kind of nice, and now it's really picking up a ton of momentum. This is what set up that covered call that I placed 2 days ago on this one, which has been, again, very nice to see. It's looking very, very good right now. Now, all things being equal, this rally is kind of hard to sustain. So at some point, I'm not saying it's going to happen right away or even next week, but it's got to start. People are going to start taking profits. We're going to see the stock trace back a little bit. I will not be surprised if I don't get called out of this trade next week for that reason. Because if we start to see any profit taking here, we'll probably drop below 23, and I'll still hold the stock. That's okay. Here's my purchase price here, $20.50. I've been selling calls on this. I've been taking in the dividends. I'll keep selling covered calls. I'm okay with that. That's kind of nice. This is a rare case for me because I do tend to take a little bit more passive approach. I don't usually get to ride trends for very long. So this is a rare exception to the rule. It's kind of fun. All right. Well, we've got just a few minutes left in the hour that I planned. So we've talked about the stocks that I intended to. If there's any that any of you want to throw out and for the group, or just get another set of eyes on, feel free to put them in the chat and let's take a look. All right. Well, and if there aren't any, here we go. Thank you, Barry. Has a Walmart call for 100 expiring on 8/22, and it's taken off. And Jay is still playing with DVN. Yeah. Oops. There we go. And DVN is just kind of basing. It's not doing anything really all that remarkable. But again, consolidation periods aren't bad, right? You can do a lot with those. So here's Walmart. Yeah, it has kind of taken off on you. You could get called out before the 22nd. Jay, that's exactly right. Thank you. And let me go, Barry, I'm gonna go back here for a second back to Devin, because you hit it just right, Jay. Here's the thing about these consolidation periods. They really make it possible to just sell option after option, whether you're talking about put selling or you end up owning the stock possibly, and then you're able to start selling calls in these kinds of positions. He says, I keep selling call after call after call. And that's awesome because you're just able to keep generating income on that stock. This one is starting to see a real narrowing of the long-term downward trend, the 200-day moving average relative to the 20-day moving average. And even though it's varying, I'm just going to kind of just draw a straight line here. You know, we're starting to see the distance between these narrow, right? I'm sorry, I know my lines are ugly, but we're starting to see the distance here narrow. So we're getting a narrowing wedge on this. At some point, it's going to break. And considering the length of the downward trend, that could still go back down. But considering the strength that we've seen since April, and the way that it's tracing up towards the moving average while it's above the 200-day moving average, it very well could also break up. That would be interesting. Gib, I have a long question. I hope to send you an email this week when I can make a question that makes sense. Gib, by all means, please do. I'd be happy to get it. Barry talking about Walmart again, in it at around $60. So you got a $40 gain. You brought in $1.75 in premium on the 28th of July. I'm really sorry for your suffering, Barry. You got to give up $4 a gain. That's a really, really hard trade to take. Actually, thank you for sharing that, Barry. That's so awesome. That's a really, really great result. And Jay, for what you're doing with Devin, you got one too. So awesome job. These are great results, and I appreciate you sharing them with me. We are at time, so thank you everybody for your participation, for being here. As always, this is an enjoyable hour for me. I really take a lot of energy from this, and really appreciate everybody's participation. If anything comes up between now and next week, please don't hesitate to let me know. Send me an email, rebelincomesystem@gmail.com. Reach out on Substack or on Discord if you're on Discord. Thanks again, and we'll see everybody next week. Thank you, Carl. Not really wanting to part with it, Barry, but figured if I get called out, I can use those funds for income streams. You bet. Absolutely. Still a good result no matter what, right? So thanks again.